All right, lovely. So then we'll kick proceedings off for this month. Hello, everyone. You have never heard of me before. My name is Rebecca Jones. I am a former financial journalist turned crypto communication expert, and I am here to lead you through this month's Truflation inflation for May. Well, technically April, because we're talking about data that is last month in terms of the BLS analysis. So, as usual, Oliver will start with analysis and the rationale behind it. Then Stefan and Ivan will discuss the analysis before we open the floor to today's guest speakers, who are, and I believe we are still waiting on TED Talks Macro, a financial commentator with over 100,000 Twitter followers, offers insights into cryptocurrency markets, focusing on macroeconomic fundamentals on his YouTube channel. Then we've got Alan Lausch, who is here. Alan, do you want to say hi?
Hey, everybody. Good to be here.
Alan describes himself as an Earth positive economy groundbreaker. Is that right, Alan?
I think that's how Steph put it, but yes, I think that's a good description to kick it off.
Do you have a better way of putting it?
Sure, I would just say that I'm focused around how to transform an extractive economy into a regenerative one. So that's kind of the idea, and my background is as a risk manager. So I have kind of a deep understanding of financial markets, and would like to share some insights around that as well.
Exciting. Well, I think you're going to have a lot to say when it comes to inflation. Okay. And then we have Joseph Schau, who is here joining us as handle at 0x50SO. He's from the Israeli blockchain.
Hey guys, how are ya? Good to be here. I'm just the guy who has an opinion, and hopefully I'm gonna be the voice of the regular people in this conversation. That's the goal, right?
That would be great. We do love the voice of the regular people, especially ones like me that aren't necessarily of the crypto landscape. But we are talking inflation today, so hopefully I should be able to keep my head wrapped around it. Just before we kick off, a reminder to everyone, we do want this space to be respectful and focused on the data and the interpretation of the data. So if you have any questions, make sure to send them as tweets to @Truflation. I'll monitor the feed and ask those questions as we go. So thank you for everyone for being here. I'm sure more people will join us as we go, but for now, I will hand it over to Oliver.
Hey, thanks a lot, Rebecca, and Yosef and Alan. Great to have you join us this session as well. Looking forward to hearing your insights as well on the inflation trends. As for everybody else, it's good to have everyone back on the call again. I can't believe it's been a month since we last spoke, and how so much has happened in that month. So where do we start? Let's start off first of all with the drop of inflation as reported by the BLS at the end of last month, which is for the month of March, which dropped from 6% in February down to 5% in March. So it's a 1 whole percentage point drop on a year-on-year basis, which was a significant drop that we saw. And the main driver on there, the core inflation numbers were going up again. The main reason for that drop was predominantly because of utility prices. And I'll come to explain that. But that was the significant drop in the numbers that caused the inflation number to drop that significantly. Since then, the Fed met last week and reported out another 25 basis point increase in interest rates, getting up to 5 to 5.25%. With the assumption that we are now in a more of a holding position, although the Fed hasn't said that it would not be open to further interest rate hikes should the situation deem necessary. But the focus is very much from Jerome Powell to get prices under control. That seems to be his biggest priority, and get the inflation down to their target objective of 2%. So now we're coming into the April reporting number, which is due out tomorrow, just over 24 hours. And I think the key thing is just trying to understand what's happening in the marketplace and the inflation last month to what would likely be the April number from the BLS, but also what are some of the trends that's driving those changes as Truflation sees it, based on the 18 million items that we're tracking with over 40 different data sources that we're operating with. So in a nutshell, as Truflation reports it, we're expecting it to be for a reversal in inflation numbers, and the downward trajectory that the BLS has been reporting on for the past 4 months, or 3 months, sorry, of 2023, will see a reversal trend in April. And in fact, we're expecting that number to go up from 5% in March to 5.1% in April. That is not out. If you look at the market estimates, where is everyone predicting it? Everyone's got a bit of a range. The range is quite narrow, but the range is operating from about 42 analyst predictions have come in. They're ranging from 4.8% to 5.2%. And we're expecting, based on people utilizing our data and us utilizing our data to predict the market, we're expecting that number to be at 5.1%. So what are the key drivers of what's happening in the month of April that's causing some of these shift changes? I think there's 3 massive trends that are causing an upward trajectory. First of all is commodity prices, in particular around crude oil prices. We have seen the OPEC cutting production by over 166 million barrels per day. That coupled with restriction of supply, coupled with an increased demand in the marketplace, be it through a particular big driver of the increase in demand will be China, but also this sort of revenge travel that is now seen as a surge in travel and surge and also in demand for oil as well. So what we're seeing is, if you look at the WTI oil prices and the commodity market, looking at around $83 per barrel. So that's one major factor, and that's logically, no surprise, is affecting what people are paying at the gas pump, right? And so the fuel prices are up about nearly 5% in April versus the previous month. And so although the cost of a gallon of gas remains lower than a year ago, given the supply constraints by OPEC, we might see further stretching of the budgets that an average consumer has will be even thinner. The other one is then the utilities market. If you look at all the commodities of the sort of energy sectors, you're seeing there's an upward tick in the future commodity prices. Yes, it's based on the future prices, I understand that, but there's an uptick there, and so we are expecting, and in result of that, we've also seen uptick in April numbers of electricity in particular, and that's the largest expenditure bucket of utilities in the American household. And that's nearly up about 1.5% versus the previous month. So that's a big driver that we have seen in the marketplace as well. I think the third major factor that we're seeing is actually in the apparel industry. Again, a different reason, but the apparel industry has seen a significant growth month on month. So from shopping for men or for women or for children or buying footwear, all consistently have seen a significant rise in prices, and a large bulk of that increase in prices has a lot to do with supply chain, logistical costs, but also import duty and tariffs imposed by the U.S. government in the U.S. from countries where the products are being produced, and the biggest one that's been affected is China. So that's having a significant effect on the higher costs in the apparel industry as well. The good news there is that the cotton prices and linen prices and wool prices and the commodity markets are coming down. So there is sort of a light at the end of the tunnel that should allow us to see some of these prices coming down in due course. The major trend, or the major category that's bucking the trend, so to speak, is housing. Right, housing will start to finally see a decline in the BLS numbers, but before we get too excited about that, because of the interest rates coming down, there's a lot more activity in the marketplace. So there could be a demand-driven growth in the housing sector as we come out of this, purely because not only is the 15 and 30-year mortgage rates declining, but we're also seeing a huge number of increased activity in the marketplace. The average house sales that have been made in the marketplace has increased from 550,000 September last year to about 680,000 in March this year. It's been continuously going up month over month. And not only is the number of properties being sold every month increasing, we're actually starting now to see the average and median prices of both the median prices of properties sold increasing now as well. And the average prices increased by about 13% over February versus the previous month, and then median prices increased by 4%. So there's an increase in demand for housing being sold, and combined with the prices going up. So certainly expect the housing market to start to see a bit of a rebound in due course, not an immediate, but certainly in due course as that comes out. The other interesting data set coming out today, which one should keep in mind out for, and I'm expecting it to see some increases, is household debt information. And if you continue to look at the household debt, that's increasing as well. So yes, from a macroeconomic perspective, other data sets such as the labor market still remains tight. Inflation, unemployment is still hovering around 3.2%. If you look at 3.4%. If you look at GDP growth, that has come down. The Q1 numbers dropped from Q4 of last year, 2.7% or 2.9%, can't remember which one it was, down to 1.1% in Q1. So that has seen a decline that we're experiencing. Retail sales are still strong in the US. And finally, the wage inflations, or the wage growth that we're seeing in the marketplace is still very strong. It's coming off a bit, but still very strong in the marketplace. So there are mixed indicators in the marketplace, and certainly be looking forward to seeing what comes out tomorrow. And just before I hand over to Stefan or Ivan and our guest speakers to make some other additional closing comments, I just wanted to end up with this, which is to say, I think with the marginal increase that we're expecting the BLS to come out with tomorrow, it will put additional pressure on consumers, I think, and on the Fed to make a decision of what they do for the longer term. The next meeting they're having is in the middle of June, and so they'll have two cycles of BLS, but also the PCE numbers are likely to go up as well because they're having a consistent trend what we're seeing in the CPI as well. So on that note, I will hand it over to see if Stefan or Ivan have got any comments, and then I'll pass it over to our guest speakers.
Yeah, so I guess Stefan and Ivan, you guys can kind of jump in and give your initial thoughts, and then perhaps we will speak to Alan and Joseph and see what they have to say about this month's data.
Yeah, I mean, I think, we saw the Fed raise interest rates another 25 basis points last week. So I think they're anticipating a strong inflation. They're adamant of bringing inflation down to 2%. I don't know why, arbitrary 2% number, but it seems like a number that they like to stick to. So that's what they're going to. We're seeing a concentration in banking, and JP Morgan getting stronger and bigger in terms of asset value. So these systemically important banks, so the SIBs, are growing in essence and are becoming more and more systemically a part of the centralization movement in the fiat ecosystem. We see on Truflation.com inflation still coming down. We're down at 3.8% right now. And we've always said we think that the metrics and the systems that we use are more modern, transparent, and have a bit more insight. So much so that the BLS numbers, to a certain number, housing, Oliver was talking about earlier, we believe we're about 9 months ahead of them. And so, that's sort of coming down from their reporting perspective. It's super hard to continuously guess where they're at with the 80,000 items that they track, the 477 people that they have going around taking price information manually and uploading that based on a panel basis, things like that. So it's always really hard to predict where they're coming out. But we're seeing the SDRs, so the strategic oil reserves in the US, They're depleted. Gas prices gone up significantly since, and the Arabian states don't really, are not a big fan at the moment of keeping oil prices low. They just reduced their barrel output by 1 million barrels. And then also the onshoring activity. It's going to start requiring less economies of scale that the global economy have benefited from. It's going to bring and need more capital to invest onshore development and fabrication and manufacturing capability. In order to do that, capital is required. Cost of capital has gone up, as we've seen. And so these are all at a macro level showing signs of sort of pain points and inflationary points that are continuously going to be out there. Not to mention, whilst the Fed is increasing interest rates, at the same time, it's offering out to a large part of the banking ecosystem a liquidity pool. So they've offered a liquidity pool. Stake your T-bills, your 10-year T-bills that are earning 0% interest here to maturity, and in return, we'll give you liquid US dollars. So it's like a liquid staking derivative that they're creating with the dollar, or the liquid staking dollar opportunity that they're offering. And that, of course, is bringing...
That's hilarious, man.
Yeah, right? I mean, if you think about it, they've copied and learned from DeFi.
Well, before we go too far away from inflation, I'd like to just sort of jump in with a question from Kevin, who has noted the big disparity in analyst forecasts for this month. So, are there any specific things we can really point to in terms of what's creating this kind of disparity?
Well, let me briefly jump into this one. So the disparity and the range between predictions we've seen worse or bigger in the past, where we had differences between lowest and highest prediction being even 1 percentage point. So I would call it this month is good. But the differences are definitely coming from the biggest category, and that's housing and transport, where we see a reversal of the trend, or even increasing speeding up the increase of the prices within the transport category, while the housing, we are still seeing or trying to see how BLS numbers are acting or in which direction they're going. Because if we look at the housing markets, they're not slowing down at this point, even though seasonally April is the month where housing market starts to typically peak. But we are not still seeing that according to the numbers of our data providers. So I would say those two industries at this point are the ones that are driving, with utilities creeping up as well.
Okay, great. Well, just to open it up to our guest speakers at this point. So, I mean, Alan, maybe we can touch a little bit on, the wider macro trends, but also I think, the point that Stefan raised, which really taps into the Fed's economic policy right now and the effect that it might be having on inflation, might be something that you could speak to.
Yeah, sure. Happy to comment. The last part of the question just cut off, so if you could repeat that one, that would be great.
Yeah, sure. So I was just saying, perhaps you might have some thoughts on what we've discussed so far in terms of the wider inflationary drivers, but also kind of touching on Stefan's point that he raised regarding the Federal Reserve policy, monetary policy at the moment, especially around its action with the banks and how that might be affecting inflation.
Great. Yeah, super good question. So, yeah, I'd like to just kind of point out the key macro factors here. We've seen, after unprecedented growth in money supply, during the global financial crisis, we've far exceeded that during the pandemic. So we have huge.
Alan, I think you somehow put yourself onto mute.
Okay. Apologies. Apologies. I will repeat what I just said. Um, Great. So, yeah, good questions. Starting with the central bank policy, what we've seen here is that in the backdrop of unprecedented supply and growth in money.
You gone on mute again.
Yeah, I was starting to worry it was me, but Alan, I think maybe you.
Oh dear. Okay. The mic keeps on going on mute. I'm sorry. So let me repeat here and watch the mic very carefully. Um, so the structural kind of backdrop to that I look at here is the unprecedented growth in money supply and debt that we've seen. Well, really, it's been growing since the 70s, but it was supercharged during the global financial crisis, 2008-9, and then became even more hyper during the pandemic. So we have huge money supply. And at the same time, we had the lockdowns contribute to supply chain disruptions and so on and so forth. So the spike in inflation was very clear from the policies governments pursued during the COVID era, and that's what we're fighting. We're fighting with right now. The drop in inflation has come from the shrinking of the money supply, so reversing QE and raising interest rates. So that's the downward pressure that we're seeing on inflation. So really, what that's causing is it's crushing the banks and the economy, and of course that has a huge impact. It's not the ideal way to contain inflation, to destroy your banks, because when that happens, when you destroy a bank and get a banking crisis, the result will be a massive increase in QE again, right? So that's exactly what we saw in the GFC. So we're seeing, in my view, a temporary reduction in inflation due to the reversal of QE. But with the banks going down, I mean, it's extraordinary, right? Credit Suisse, First Republic, these are huge institutions, and it's not going to stop here. We are in a red hot zone for banking crisis. We have estimates. Bloomberg published something last month. Estimating bank unrealized losses in the U.S. of about 600 billion. The funny thing is, banks don't have to report their hold to maturity positions. So you buy 30-year Treasury, and you don't on your hold to maturity book, you don't have to report the losses on that. Now the updates are Reuters and Fortune reports that this is about 1.6 trillion, right? So we're starting to already at this point start to get to some of the subprime type of losses that we're seeing. So in my view, if you look at what central banks will do in a situation where there's a banking crisis, and we've seen throughout history that you do not want a banking crisis to unfold, because the repercussions on the broader economy will be devastating. This is what Bernanke realized looking at studying the Great Depression, and QE was invented, right? So we are basically right now in a scenario where we're facing an imminent banking crisis, and it's global. Um, and at some point, the regulators are going to have to choose the lesser of two evils. And we know that the worst case scenario for the global economy and for pretty much everyone is a deflationary bust, right? So we're in a very unhealthy deflationary scenario. It's not like we've figured out how to drive costs down in a sustainable way. It's really by crushing the economy, by crushing the banks. Follow-on effects are reduced lending and so on and so forth. So, in my view, the structural reasons that I would expect a reversal in inflation are going to be linked to having to save the banking system, essentially.
But just on that note, Alan, just a quick, you've seen Balaji's posts, right, where he sort of, he thinks we're going to hit hyperinflation within the next maybe 2 months left, right?
Yeah, hope that makes sense. Yeah, that's this is the basic macro analysis, right? That of the two lesser evils, No central banker in history has ever decided to let the banks go bust and crush the economy. So they will at some point in time step on the gas pedal again and create more money.
So in a nutshell, in which case what we're in is potentially a temporary reduction in inflation, as you said, Alan, due to kind of the unwinding of QE. And I guess then the question is, is there somewhat of a slippery slope that we might fall down if the Fed doesn't act in time, or perhaps act too aggressively with interest rates, where then we can't really normalize inflation? I'm not really sure who would be able to answer that question. Perhaps Oliver, maybe you might have some insight on that.
No, I mean, look, I think the long-term trends of inflation, as Truflation is looking at it with the multitude of data points that we're operating with, is that inflation is not going away. For every data point we look at and the core leading indicators of each of the categories that we report, and their leading indicators, and you go down levels and levels and levels, and you look at external factors affecting each of those categories, there is just signs of that inflation is not going to get away in the short term. And I think nor in the long term. I don't think we're going to hit this 2% magical 2% number that Jerome Powell is trying to achieve, and the Fed as a whole are trying to achieve. So certainly not this year. And I think, second of all, I think the other factor is going to start playing into this, and what's going to cause it is the debt ceiling in the U.S., right? If you look at the debt ceiling, I think it's about 120, 125%, is it, of that of GDP. They're trying to raise the debt ceiling at the moment. And if that doesn't pass, that's going to create a whole bunch of other factors that's likely going to cause inflation to be hanging around as well, even longer.
Edward Kelso asked that very question. Lawmakers currently negotiating U.S. government debt ceiling. What are the implications for future inflation trends? I mean, you've sort of answered it, Oliver. I mean, is there anything you want to add to your answer?
No, I'm sure Alan or Stefan or Sosa got a sort of a viewpoint on this, but yeah, I think that the fact that if they miss the repayment, it'll be the first time in U.S.'s history for missing repayments, and I think that will cause a significant ripple effect that will result in inflation and the cost of credit continuing to rise and continuing to be there, and inflation still hanging around. And given Jerome Powell's comment on Tuesday or Wednesday last week at the press conference, him saying that prices are a critical factor in getting the economy back under control, I don't see that happening in the short term.
Okay, at this point, I do want to jump over. He's been very patient and he's been waiting in the background while we've been chatting. Yosef, I mean, what does all of this mean to the average person? As you were saying, you're here to kind of represent.
That's great. So basically, I think the one thing that's overlooked was when Jerome Powell was prank called by a bunch of Russian dudes a couple of weeks ago. He basically said, as he thought that he was talking to Zelensky, right? So he basically said to them, guys, we're going to raise interest rates 2 more 25 basis point increases. He basically already saw his cards out earlier, right? And what's unfortunate is that the government always does what it wants to do, and they just somehow want to quantify it using the data to sell to the public that, that's just what it is. So I think that they're going to raise the rates no matter what it is, and whether the inflation is going to go up or down, they have a much bigger, thing here at play. And the government is going to default or not. It's not going to default. I mean, it's been I think over a dozen times that it happened all the time, and they always increase it and increase it and increase it. And, they're not going to let the U.S. government default. Maybe for a couple of weeks, like it happened a few times. But eventually they're going to go ahead and raise the ceiling, because once again, the Washington is going to do what it always does. And it's just going to justify to the whole world saying that this is why we did it. We had no other choice but to do it, right? So that's just what I think about how as an average guy, that's just what I think is going to be. So.
And is that, what is that? Is that the sort of the end of civilization as we know it, or nothing's ever going to change because the US government's never going to be allowed to default, and the US dollar will always be our global reserve currency? What does that mean for crypto?
I think that, you already see that like the BRICS nations that are already setting up like alternative ways, and Chinese yuan is most traded currency right now, if I'm not mistaken, right? And like the government of US has always been selling to the whole world that US dollar is the safest currency in the world. Trade with it, do it, and we will make sure that we guarantee its safety. But then on the other hand, you have all these banking crises that are going on. You got banks basically like falling down like hot potatoes. You know what I mean? Like, I guess it's good for JP Morgan because it's good for their M&A growth strategy for the long run. So I guess it's good for them. I mean, they're expanding and acquiring new markets that they didn't want. So I guess whatever, right? Good for them. But the point is that like, does anybody really trust US dollar? I don't know. Like, all we know is the fact that the prices are really going up and people are not rioting yet. Unfortunately, we see a lot of riots that are happening because of like social issues, and good for them. But we haven't seen rioting happening because of the cost of living and because of the fact that people cannot pay their bills and all that kind of stuff, right? And I think that if we're just going to continue this path of just US government just bailing out every single bank, that instead of guaranteeing an account to a quarter mil like FDIC does, right? They're just gonna take over banks and just basically nationalize them one way or the other. It's not gonna bring any good hope for the US dollar, right? And that just leads you to the fact like what do you really have to protect yourself if crap hits the fan, and looks like it's gonna. When is the big question? We don't know, but it's gonna happen, right? What are we going to hold to protect ourselves, like literally? And that's where like gold used to be the answer, but good luck hoarding a lot of gold coins. I mean, how much gold can you really hoard, right? That's just
Well,
what it is.
how big your
And
basement is. Yeah.
no, but it's susceptible to theft. I mean, think of it this way, right? If people cannot pay their bills and if people are robbing supermarkets and just to support themselves and pay for food, right? Does your basement, and if they think that you have gold, is it really secure? Not really, right? And that's where kind of like a cryptocurrencies come in, where like things like Bitcoin and Ether and so forth, right? Stables, is the fact that on a somewhere in the realm of digital world, your coins are just stored out there, and you can be on a little ledger, on a little piece of paper that you can keep in your shoe, and that's it. Just run around if you need to, right? And that's just, I think, that where we headed to. It's unfortunate to say that, but like, I think that the whole idea of money, and as we understand money, is going to be changed very soon, because the same concept of money that has been around for hundreds of years, right? It just doesn't work for the new age that we're in, where everything changed, like literally everything has changed over the past, like, not even 100 years, over the past 20 years. Like, we live in a totally different world, right? And that's just the reality, that money is the next one to change, and hopefully it's going to be beneficial for all of us.
Absolutely. Well, listen, we've only got a few minutes left, so we do actually have Matty Greenspan here, somewhat of a kind of a surprise drop-in guest. Hi, Matty. I mean, I have no doubt you might have some thoughts regarding, whether it be this next inflation print or the wider issues we've just been discussing. Do you have any thoughts you'd like to share with us?
Well, yeah, one thing that I wanted to mention, just I heard a few people say that the U.S. has never defaulted on its debt, and I do believe that it has several times. Even Joe Biden tweeted out this false statement that the U.S. has never defaulted on its debt, and there was immediately a community notes that popped up fact checking him with sources saying yes, it has several times. But one thing that I wanted to actually ask, because what doesn't really make much sense to me is, the difference between the Truflation data that we're seeing saying that inflation is at 3.8% versus the government statistic, government reported statistic of 5%. So actually, it would seem that the government is overstating inflation. And I guess that would kind of feed into Soso's narrative that they just want to raise rates. They don't really care about inflation as much. Maybe they're trying to actually overstate it just to, that also kind of makes sense given the context that, Jerome Powell and others have actually sold all of their stock market holdings and their portfolios at the top just before they started to raise rates. Possibly they're doing this as a way of market manipulation, and that kind of is makes a lot of sense, given the way that government officials have been behaving lately in a very corrupt manner.
Well, a little bit like when Larry Fink, bought what has now become the world's biggest ETF business just before he told the Treasury to start printing money in 2008. But yeah, the top guys know what they're doing. I mean, Stefan, to answer Matty's question regarding that difference, did you want to kind of step in there between 3.8 for Truflation and 5 for the BLS?
I think it's just a different lead time, right? We aggregate in real time. We're not a month behind. We don't use manual solutions. We actually have real time feeds from a lot of the sources that we aggregate from, over 60 plus different sources, and broken down into multiple subcategories in categories that then feed up into the true CPI. So we're just taking a modern approach to how one could track inflation metrics and the changes in prices that people experience. And that's all. So I think we're just ahead of them, and ultimately we're trying to be transparent about it, how and what is weighted accordingly to a basket, and display that. And we're trying to get more and more transparent as we build out systems to support that transparency. Whereas the BLS reports into the government, is a part of the government, is a government institution, and so ultimately is also working off a scorecard that they create after government has supported that scorecard. They then create the score and then publish the score to manage their own performance, which we just think is slightly, you got a vested interest in showing a specific number.
Yeah. Okay. So in summary,
so you don't suspect any foul play?
No, of course not.
not that he'd like to say anyway. But okay. So in summary, Truflation data is effectively a month ahead, of course, of BLS data, because BLS still, I believe, uses papers and pens to record its data and has much fewer data points. So you could feasibly expect the BLS numbers to be catching up with Truflation, weeks and maybe even down the line.
But you know what? One thing I do want to bring up. Sorry, and so you mentioned it, right? And just around the U.S. dollar de-dollarization that everybody's talking about. And I do sort of, everybody looks at what other alternatives are there, right? We mentioned gold, and we've seen the gold price spike, but where am I going to carry my gold? How am I going to carry that around? We mentioned the renminbi, and the renminbi is, however, still pegged to the dollar, right? And so ultimately, if you add that up together, you're looking at the dollar still dominating some 80+% of worldwide trade, being denominated in dollar. However, you're seeing new trading partners emerge that are starting to look at alternative currencies and not denominate in dollar anymore, that are now more powerful than the G7, right? I think there's more trading volume, as Sosa was alluding to, between the G7, between the BRICS nations versus the G7. So there's actually more trade intra those BRICS nations. So they could actually just go off and set up their new coins, or new currency, and denominate all their trading contracts in a single new standard. And over time, will any other fiat currency be as transparent as the cryptocurrency, right? I think transparency really matters in a world where trust is really breaking, and crypto has that transparency, right? Bitcoin, Ethereum, you have full transparency in terms of where the funds are, the wallets. It's decentralized. It's nodes across multiple different jurisdictions, so they can't shut you down in one jurisdiction versus the other. And the other alternatives is spend and buy what they're doing in markets that are high inflationary, right? In Argentina and Turkey, people go out and spend right away because they're worried that tomorrow they go to the supermarket, prices will have gone up 20%, 30% in 1 month, right? And that happens on a monthly basis. I don't know where that leads us, but it's definitely changing the dynamics in in a global economy.
Right.
And what does that mean? And what does that mean to inflation? What does that mean to the worker or the average person that is living day to day and paying their expenses, and in some cases, don't necessarily have appropriate savings that they can draw down on, or those savings are going to go away anyway. So what's the point saving?
I hate to end the show on what's the point in saving, but we are at time. So I would recommend everyone probably do try and save a little bit. But in the meantime, just to kind of summarize where we are on the Truflation inflation analysis, Oliver, could you just give us the kind of headlines on what we're expecting from the BLS tomorrow, and what's important about our data?
Yeah, sure. I think the BLS tomorrow is likely to come up with a higher number, and the upward trajectory is going to be small, but we're predicting the upward trajectory to be 5.1%, rising up from 5. As I said, the key drivers being driven by oil that's impacting utilities, gas prices, and of course the tariffs and import duties on the apparel sector. So that's the big highlight for tomorrow's numbers. I think, as Stefan and everyone has reiterated, I think the big strengths of where we are predicting for Truflation and why we have, obviously we are biased, but we also have a firm belief that our numbers should be part of the table in discussions when the FMOC and when the Bureau of Labor Statistics review their numbers. Our numbers should be part of that discussion, because when you're making such an important decision around economic data, you need to have a figure that is up to date. It's got greater breadth, it's got greater depth, and is tracking significantly more goods and services. We're tracking over 18 million prices of goods and services compared to the 80,000. So it's a lot more comprehensive.
Right.
So hopefully that gives everyone a good summary.
Let's use computers rather than pens, right?
Yeah. What I'd like to do is ask, what given the fact that we're seeing a potential rise in inflation rate, what is the group's sort of here around the table? Maybe just a quick summary. What are your investment decisions based on the macro environment that you see right now? And maybe we go around to everybody and just give us your insights in terms of what you think and how you are going to be placing your bets, and what investments are you going to be making?
Sure. Okay.
And maybe start with Mati.
Yeah, I mean, in a word, 2 words: buy Bitcoin. I don't know if you guys have been seeing what's going on with the ordinals lately. They sent out a newsletter the other day all about the meme market that's found its way onto Bitcoin. The transaction fees are up to $30 per transaction now. The mempool is just completely flooded, and all of this drives excitement around Bitcoin, around digital scarcity. Regarding inflation, I mean that should be a no-brainer, right? I mean, Bitcoin was created as a way of opting out of that system.
Thanks. And maybe Michael, what are your thoughts, and where are you going to start placing your bets, and how are you going to do it?
Thanks for inviting me up. Great discussion. I would say that Bitcoin waxes and wanes with the fortunes of the stock market. So it's not nuclear physics. If the stock market's going to trade at 3,200, Bitcoin is going to trade significantly lower because it's a risk asset and people will be in liquidation mode. I think that paradoxically, it inures to the Fed's benefit to actually cause a episode of deflation, because that's the only way they're going to make the banks and themselves solvent. So I'm expecting deflation ahead, combined with a much lower stock market. Thanks.
But if they wanted to do that, why would they be raising interest rates? Wouldn't that operate counter to that narrative?
Maybe they drop inflation. Maybe they drop interest rates afterwards.
Actually, I want to say something real quick, right? If it's okay with you guys. Let's face it, all right? Over the past 40 years, there has been, 8 or so major swan events that happen in the capital markets in general, right? Depressions or recessions and so forth and so forth, out of which you had about 3 or 4 of them that needed a bailout by the government for the industry to function and move forward, right? In crypto, we had like the same exact events happen only in 2022, whether it's quantitative tightening of the 80s with the interest rates all the way down to, banking crisis. I guess Anchor Protocol was sort of like a bank, at least for a lot of people. And then the collapse of Celsius and, Luna and so forth, all the way down to, FTX and Bernie Madoff, I guess, dot-com bubble, all the valuations that got slashed. So there's a lot of parallels that are happening with like over the past 40 years, what the financial system went through and what crypto went through in 2022. The only difference is that crypto survived without having to get bailed out, without any bailouts whatsoever. And for one reason or the other, there's still like hundreds of thousands of people that are building and that are working, right? So that's one of the reasons why I'm in love with this industry and why I think that crypto is the future, because we show the resilience that no other industry showed whatsoever, you know what I mean, over the same period of time. So like what my bets are long run, I don't even have a doubt about it that, yeah, government might even go as far as outlaw crypto, but in the long run, you know, crypto shall rise again, Bitcoin shall rise again, and this whole new revolution that we are all part of is going to be, what's going to lead us all to the next greener pastures, I guess, of the real revolution of the money and so forth and so forth.
And you, Alan?
Cool. So yeah, I'm of course big proponent of crypto, and that's the, the core allocation. But I wanted to say something inflation related, which is that in the long run, farmland and forests have outperformed gold and anything else on an inflation adjusted basis because of the yield that they have and the stability of the underlying value. So I believe the best bet right now is to buy all kinds of land with potential access to water. And apply regenerative agroforestry to it. Create land where humans can live, animals can flourish, where there's real growth, and that will outperform a dead asset like gold. So to me, that's the barbell allocation: crypto plus productive regenerative land.
All right. Well, I think maybe we will wrap it there if nobody has any objections. So that's been a really interesting conversation. Thank you, everybody. Thank you to our very special guests. Thank you, Alan. Thank you, Jota. Thank you, Matty and Michael, for dropping in. Apologies, Michael. I didn't sort of see you drop in there, so I wasn't purposely ignoring you. But just to let you know, of course, we do every single month. So do stay following Truflation to make sure that you know when the next one is coming up, because as you heard today, there are always really, really useful insights, whether or not you are trying to invest or you're just generally interested in macro trends. Announcements are posted on our Twitter profile about a week ahead of time. So thank you, everyone, and I hope to see you all again next month.